All right, let's dive into some really cool research today. You sent us this paper that's using AI to analyze what managers are really saying, not in private, but right out in the open on their earnings calls.
Yeah, it's amazing the amount of data they used, over 120,000 transcripts from 2006 to 2023. It's like we're eavesdropping on like 2 decades of conversations with corporate America's top people.
And they didn't just skim these transcripts, right? They used ChatGPT 3.5 to create something they're calling the AI economy score.
Yeah, so this score is basically measuring how optimistic or pessimistic each company sounds about the U.S. economy.
Okay, but the really intriguing part is that they're claiming that this score can actually predict the future of the U.S. economy. And they say it's even more accurate than those, super secret forecasts from the survey of professional forecasters.
Exactly. And it even does well compared to traditional economic indicators, too.
Okay, I am officially intrigued, but before we get into all the predictions, how did they teach an AI to, understand the nuances of earnings calls? Like, reading between the lines of corporate speak can be tricky even for us humans.
It's a great question, and it really shows how powerful this research could be. They didn't just, throw the transcripts at ChatGPT and hope for the best. They actually designed very specific prompts, essentially asking the AI to analyze sections of text and then rate the company's economic outlook on the U.S. economy using a specific scale, from like increase substantially to decrease substantially.
So they gave the AI a framework, but how do we know it wasn't just picking up on random correlations? What if strong revenue growth happened to coincide with a good economy, but it isn't actually a reliable predictor going forward?
Well, they actually anticipated that, and they put some really clever validation checks into place. So first, they manually reviewed a sample of transcripts themselves, and then they compared their own assessments to what the AI was coming up with. And ChatGPT was actually remarkably consistent with the human judgments.
Okay, that's good.
Yeah.
But humans can also be biased too.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So what else did they do?
They did a deep dive into the actual language itself. So they used a technique called n-gram analysis, which looks at how often specific phrases appear, and in this case, 3- and 4-word combinations. And what's really fascinating is that these n-grams, they basically act like fingerprints for, different levels of optimism.
Wait, hold on, n-grams. Could you maybe unpack that a little? Like, why are these word combinations so important?
Sure. So imagine you're like a detective at a crime scene. You're not just looking for individual clues, right? You're looking for patterns that tell you a story. And n-grams are basically like these patterns in language. So for the companies that had low AI economy scores, common n-grams were things like challenging economic environment or remain cautious. And these clusters of words, they really paint a picture of uncertainty.
Okay, that makes sense.
Yeah.
So I'm assuming that companies with high scores were probably using phrases like record profits and expansion plan.
Exactly. Their transcripts were full of n-grams like strong financial performance and increased market demand, language that signals confidence and growth. And the researchers even included some examples in the appendix, and it's pretty striking how clearly these n-grams reflect the overall economic sentiment.
Okay, so the AI is definitely picking up on meaningful signals in the language, but can we really say that what managers are saying is actually predicting the future? It still feels a little like we're reading tea leaves.
Well, that's actually what makes this research so groundbreaking. They actually found that the AI economy score significantly predicts GDP growth up to 4 quarters ahead. So what a CEO says in January could give us a clue about how the economy will be doing the following January.
Wow, that's impressive. And they didn't just stop at GDP, right? What other economic factors did they look at?
They also looked at industrial production, employment, and even wages. And the AI economy score was super accurate for those two. In some cases, it was accurate up to 10 quarters ahead. This really suggests that managers have unique insights into economic trends, stuff that even the most sophisticated models might be missing.
10 quarters is 2.5 years. Are you saying that what a CEO says today could tell us about wages in 2027? That's mind-blowing.
It definitely challenges our assumptions about what information is truly valuable when we try to understand the economy. And remember, these predictions, they controlled for other economic factors, so it's not just a correlation. It really seems like things managers are saying contains valuable information.
So we've basically been ignoring a treasure trove of insights hiding in plain sight. This is making me rethink how I consume financial news. But they didn't just focus on the overall economy, right? Didn't they look at specific industries too?
Yeah, they basically took the same AI-powered approach and created separate scores for production, employment, and wages at the industry level too, which allows for, a much more granular analysis.
So for example, they could tell if tech companies were feeling more optimistic about hiring than manufacturing companies.
Exactly. And once again, these industry-specific scores were remarkably accurate at predicting what actually happened.
Okay, this is getting really interesting. Before we get into those industry-level findings, though, let's go back to those professional forecasters you mentioned earlier, the ones who were supposed to have the gold standard predictions. How did the AI economy score do against them?
This is where it gets really interesting. In a head-to-head comparison, the AI economy score actually beat the professional forecasters' predictions of GDP growth.
Wait, are you serious? So all those economists with their fancy models and all that data, they were beaten by an AI listening to earnings calls.
Yeah, it's a pretty remarkable finding, and it really challenges our assumptions about, where we should be looking for information about the future of the economy. Maybe the wisdom of the managers is more valuable than we thought, especially when we use AI to analyze it.
This is definitely making me think differently about investing and business decisions. It's like having a secret weapon for peeking into the future.
Exactly. This research is a powerful reminder that sometimes the most valuable insights are the ones hiding in plain sight.
This is mind-blowing stuff.
So, before we get too carried away with predicting the future, this research, while promising, does have its limitations.
Okay, let's play devil's advocate then. What are some reasons why we shouldn't just ditch all of our economics textbooks and base all of our decisions on what CEOs are saying? Like, what could be skewing these results?
Well, one thing is that the researchers themselves acknowledge that their study focused on just earnings calls, which are, a specific type of communication. And these calls are really structured, often carefully scripted, and aimed at a specific audience, investors. So it's possible that managers are more guarded in what they're saying than they would be in, internal memos or private conversations where the stakes aren't as high.
So there's definitely a performance element there. They might be downplaying risks or hyping up positive developments because they want to, present a favorable picture to the market.
Exactly. It's also important to remember that the research really just focused on publicly traded companies, which are usually larger and, more established than private companies. So their experiences might not really represent the broader economy, especially when we're talking about things like hiring and wage growth, where small businesses are super important.
Yeah, that's a great point. The economic realities of a startup are definitely different from like a Fortune 500 company.
Yeah.
Their outlooks could be totally different.
And we also can't ignore the time period that the study covered, which included two major recessions, the 2008 financial crisis and the COVID-19 pandemic. These were really unusual events that had a huge impact on the economy, and it's possible that managers' predictions were more accurate during these periods of extreme volatility than they might be during times that are more stable.
Yeah, it makes sense that when things are changing super fast, everyone's trying to figure things out and people on the front lines might have a clearer view of what's next. But predicting a stable, predictable market, that might be a totally different story.
Exactly. We also have to remember that the researchers couldn't control for every single thing that could influence the economy. Things like government policies, global economic conditions, even things like natural disasters can really mess up even the most well-informed predictions.
So while this AI economy score is a really powerful tool, we can't treat it like it's some kind of oracle.
Right, exactly. We need to use it as part of a broader analysis. And let's not forget, AI, while incredibly sophisticated, is still a tool. It's not a magic crystal ball. It's based on patterns and language, but language is complex, nuanced, and context-dependent. So there's always a risk that the AI might be picking up on things that aren't really there or misinterpreting what people are saying.
So basically, we still need to be skeptical and think critically when we're interpreting these findings. We shouldn't just blindly follow the AI, but use it to ask better questions, really understand the data, and think about the context.
Precisely. That's why having these conversations is so important, to really understand the research and its strengths and limitations. It's not about replacing human judgment. It's about using new tools to make it even better.
Now, you mentioned earlier that the visual in the appendix of this paper, the heat map showing industry-specific scores over time, really stood out to you. What was it about that visual that you found so compelling?
Well, it really shows how different industries experience economic shocks and how those experiences play out over time. Like, for example, during the 2008 financial crisis, industries like retail, transportation, and warehousing were hit really hard. And these are sectors that really depend on consumer spending and global supply chains, which were both disrupted during the crisis.
And healthcare and utilities were more resilient because people still need to go to the doctor and use essential services no matter what the economy is doing. Those sectors tend to be more stable.
Right, exactly. And the heat map shows how those patterns played out again during the COVID-19 pandemic. Retail, which was already going through a transformation because of e-commerce, was hit hard again when lockdowns and social distancing happened and reduced in-store shopping even more.
Meanwhile, healthcare, especially telemedicine and remote services, saw a surge in demand because people were trying to find ways to access care safely during the pandemic.
Yeah, and the heat map also shows how quickly some industries bounced back after the initial shock. After the 2008 recession, sectors like technical services and manufacturing recovered really quickly because they're often driven by innovation and can adapt quickly to a changing economy.
While sectors like construction, which depend more on things like large investments and infrastructure projects, they usually have to wait longer to recover.
Exactly. And this kind of industry-level analysis is incredibly valuable for investors and policymakers.
Can you maybe say a little more about that? How would people actually use this information?
Well, for investors, it's a great tool for finding sectors that might be ready to grow or for finding sectors that are facing challenges. Instead of just betting on the overall market, they can make smarter decisions about where to put their money.
So it's about going deeper than just the headlines and understanding the nuances of how different industries respond to economic changes. You can spot opportunities and risks that might be hidden within the broader economic trends.
Exactly. And for policymakers, understanding the unique challenges that each industry has can help them create more targeted and effective policies. They can provide help to industries that are struggling or invest in projects that will benefit sectors with high growth potential. Or they can adjust regulations to encourage innovation and job creation in key areas.
So it's not about treating every industry the same, it's about recognizing that different sectors have different needs and contribute to the economy in different ways. This research shows us how AI can be used to get insights from unconventional sources and how those insights can be used in the real world.
Definitely. It's a reminder that we can always learn more and that sometimes the most important insights are hidden in plain sight, just waiting for us to uncover them with the right tools.
This has been a really interesting discussion. So before we wrap up, I want to make sure we've hit all the key points from this research. We talked about the AI economy score, its ability to predict the future, the importance of looking at things by industry, and the need to be critical when we're interpreting AI-generated insights. Is there anything else we need to talk about? One thing I keep thinking about is that we were talking about the big picture, GDP, national trends, industry impacts. But this AI economy score, it also works at the company level. It's like you can get a sneak peek into how individual companies see their own future.
Yeah, it is a really fascinating part of the research, and it could be really useful for investors. Imagine you're thinking about investing in a specific company. You can look at their AI firm score and see how optimistic or pessimistic the management is about their own future. It gives you a different kind of insight that you don't get from traditional financial analysis.
That's a really cool tool for investors. It's like you're seeing what the people actually running the company think about how they're doing.
And it's not just individual companies either. If you're thinking about starting a new business or, expanding into a new industry, you can look at the AI industry score and see how that entire industry is performing. Are companies talking about growing or shrinking? It gives you a much better idea of what you're getting into.
So instead of just looking at economic indicators and market trends, you're getting a feel for how the people working in that industry are feeling.
Exactly. It's like tapping into the hive mind of the industry. And here's what's really interesting. The researchers found that these micro-level scores, the ones for specific industries and companies, they can actually predict things up to 4 years out.
4 years. That's even longer than the National AI Economy Score.
Yeah.
Are you saying that what's happening with individual companies and industries could be a sign of where the whole economy is going?
It's possible, yeah. It suggests that these micro-level trends and expectations are like little ripples that can turn into big waves across the whole economy.
So by paying attention to the details, what's happening on the ground, we might be able to see where the whole system is going. It's like that butterfly effect. The flap of a butterfly's wings can cause a hurricane.
It's a powerful image. But of course, we need to keep things in perspective. We've already talked about some of the limitations of this research and how important it is to be critical. It's really important to remember that AI is a tool. It's not magic. We have to use it carefully and thoughtfully.
We can't just follow the AI's predictions blindly, no matter how tempting that is. We need to use those predictions as a starting point and dig deeper, question our assumptions, and think about other possible explanations.
Exactly. We should use AI to help us understand things better, not to do our thinking for us.
So after this deep dive into AI and earnings calls, what's the one thing you really want our listeners to take away from all of this?
I think the biggest takeaway is that the future of the economy isn't some mysterious force that we can't understand. It's created by the decisions and actions and expectations of all the people working in companies and industries. And if we pay attention to those signals and use tools like AI to help us make sense of them, we can get a better idea of where the economy is heading.
It's a good reminder that the future isn't set in stone. It's being made every single day by the choices we make and the things we do. And if we have the right information and the right tools, we can all play a part in shaping that future.
Well said. It's been great talking about this research with you.
Yeah, this was great. And to all of our listeners, thanks for joining us on this deep dive. We hope it's made you curious and given you some new ways to think about how we can understand and maybe even predict the future of the economy. Until next time, keep exploring, keep asking questions, and keep learning